What's going on, everybody, and welcome to the Co-Living Show. My name is Craig Curlop,
I'm Miller McSwain.
and we are pumped to bring you an amazing guest today, Fernando Corona. I just like that tequila song comes in my head every time I say his name. So I don't know why, but to me, he's like that song. That's his like spiritual song in my mind.
Oh, for sure. Yeah. And I think I've only seen Fernando. So I've known him for maybe a year and a half, something like that. And I've seen him like 3 times. And every single time he's ended up with a mic in his hand and performing karaoke or like singing some sort of song. So totally on brand. But I will say a couple of things about Fernando. He is so far probably the most generous person I've ever met in my life. There's been a couple different occasions, but I'll give you guys one example. We were on a co-living cruise together. So shout out to Sam Wiegert and his community. He had this awesome co-living cruise that we went on this past summer, and I went to the Bahamas. And we were on that cruise, and there's a casino there. And within 5 minutes, Fernando's, let's go. Let's play the one where you throw the dice and guess what it lands on. I don't know. It was one of those. And within 5 minutes, lost my $100 I went in with. No big deal. 30 minutes later, Fernando's, come on, man. Like, let's play some more. Let's play some more. I'm like, oh no, I'm out of money. He's, dude, here's $100. I'm like, it's all good. No big deal. He's like, if you win, you keep the $100 and I get my $100 back. If you don't win, it's all good. We had a good time. And we won 3 or 4 times in a row. It's like kept doubling our money. So he got his $100 back. I was back in the game. And then the next night I lost it all in poker. So all for nothing, but it was still good fun.
It's funny how gambling works. The more you do it, the more you lose. I think the magic there is just leave when you're ahead.
Yes.
Or just have fun until it's all gone.
Yep. Yeah, exactly. So that's why on this podcast, we talk about investing wisely, not gambling away your money.
What a transition. That's an A+ transition. And Fernando, today we're going to be talking all about lending and co-living. Fernando is probably one of the most creative co-living lenders that I know. And he'll sit and I chatted with him for 45 minutes on this kind of big, confusing, weird deal that we might be doing. And he was like, again, not only generous with his money, but generous with his time. And so if you're looking for creative co-living lending solutions, Fernando not only has the product most likely, but has actually probably either used it himself for his own investments or certainly helped other people do it. So let's bring on Fernando Corona. Fernando, welcome to the show, my friend. How you doing today?
Ready, man. We're ready for it. Thanks for having me on.
Are you ready? Are you ready for 2026?
Or 2026?
Yeah. For you?
We did the planning. It's my first year ever planning for the business. First year planning with my wife. I don't know if you guys are you both married right now? I think Miller's married. Are you guys both married? I don't know if you guys have ever planned with your wife for the quarter or the next quarter and stuff, but we're implementing that into our culture. So pretty stoked for it, man.
So I'm just curious because we're doing a similar thing. Are you diving into the family value side of things, or is it actually?
Yes, we already did we have our mission statement. We have our 5 core values and sentences aligned to them. And I think that's the way to a pretty sweet future on how we want our daughters to leave our home. And it starts with our core values.
Dude, I love that. I never heard that before, but like, it's like beginning with the end in mind with your kids. Like, beginning. Wow, that's cool. Do you mind sharing what your family core values are? I'm curious.
Yes. Let me see if I can, off the top of my head, we just did them. So the first one is safe and loved. And we use that one anytime like our tone comes up, anytime we're acting out of center, so we can come back and realign and say, hey, we're safe and loved here. And so then it's, dang, I can't. All right. We're not yelling. We're not screaming. We're not scolding and things like that. The second one is becoming the fruit. So there's this like the fruit of the spirit where it's like you want to practice building your character is essentially it, right? So if somebody is out of character, or we can reference that, okay, what's our goal here? We're going to become the fruit of the spirit kind of deal. So that's the second one. The third one is we do hard things. So like my daughter right now, the 4-year-old, she takes cold showers with me. And I remind her, like, we do hard things. And so Amy, we're talking the day that we have to do something hard for our daughter. Like we had to cut her tongue tie and she was like 3 weeks. And it's hard as a parent to have to make that decision. But like, I still have my tongue tie and we know it could be better for her life. So we do hard things. Like those are like frames. So our core values, we want them to also be words that we use that we can apply in our life to realign what our core values are. So the third one's we do hard things. The fourth one, I'm forgetting the fourth one, but the fifth one is like shared lives. And the shared lives one is where we try to remove distractions. And when I'm traveling, I'm like this in February, we are moving. I'm going to take everybody to go travel with me as I work. Forget the fourth one though.
Yeah, Fernando, I just want to give you some props. So my wife and I are doing something similar right now. We're setting quarterly goals and annual goals for family, and we're working on the kid type thing right now. And we're setting like parenting type plan too. And we were talking about it actually yesterday. And specifically, I told her about when me and you were on the charter bus in Denver going to look at a co-living property. And you were telling me about the shower thing, and I think you said like Coronas do hard things, like your last name, like this is what Coronas do. And anyway, we're keeping that in mind when we're doing our family planning and children planning. Some of the approach that you had there, so
heck yeah,
it had an impact. Yeah.
Oh, that's really nice to hear, man. I love that, dude. And we use ChatGPT. We'll let ChatGPT record all of our conversation, and we'll just be spitballing back and forth. And we'll have ChatGPT kind of, what's the word, like monitor, not monitor. What's the word where
like synthesize it all?
Synthesize it, and then gives us questions on how to think through things so that it does like 50-60% of the heavy lifting, and then we fill in the blanks.
Yeah, we were talking about doing something like that yesterday too, like having it, because my wife brought up, she was like, oh, I bet we could buy some like card game or whatever that shows like questions that you ask each other as spouses, like when you're thinking about being parents and all that. And I was like, oh, we can just pull up ChatGPT and have it ping questions back at us just over and as long as we want to. You can just like make that card game yourself.
Dude, I'll send you my prompt. I'll send you the one that we did.
Yeah. Rock on. Yeah, let's do that. But that's not what we're here for, is it, Craig?
Speaking of hard things, co-living is pretty hard. And
it took Craig about 2 minutes of us talking to come up with that, but now we are segueing.
Now we're segueing. Yeah. Fernando, co-living is hard. Why the heck did you do it? Other than the fact that Coronas do hard things. But tell us about how you got started and all that stuff.
Dude, yeah, a long time ago, man. 5 years. 5 years when I bought my first co-living property. And the reason we got started was I did not have any money and I did not have any income. And at the time, the idea of financial independence through real estate sounded really nice. Without really knowing what it meant, I was like, that sounds dope. I can live off of my passive cash flow. And we started looking into real estate, and we're like spending months looking into properties. And if we spent $65,000, we'd get like $300 in cash flow. But $65,000 was all the money we had. So we're just like trying to do the math. Okay, if we want, I don't know, $10,000 of cash flow, you got $65,000. You know what I mean? Like the math wasn't mathing. And it's like, how long did it take us to save this $65,000? It wasn't my money. It was my girlfriend's money who became my wife. It took her 5 years to save $65,000. And so it's like, there's no way we're going to achieve this financial independence with a long-term rental strategy. And so at that point, my friends introduced co-living to us, and that's the path we went on.
Nice. I love that. I think probably all three of us, probably similar kind of genesis story of, I don't get it. Like we're spending so much money to get $200, $300 a month. Like people are like signing up for that. That doesn't make me get out of bed. That's a water heater and your year's cash flow is gone. Yeah. So I love that. So what was like that first property that you bought? Tell us about how you found your market, how you found the
first one.
Yeah. Go into it.
So the first one was we joined a community, much like the one you guys got going on too, right? And we realized that we didn't know everything, and we wanted to connect with people that were a little bit ahead of us. And so they started connecting us to like agents and lenders and contractors and knowing what to look for in deals. So we went through the whole coaching thing. It took us 9 months before we actually got our first property. We were probably putting in offers like around month 5 or 6. But the first 4 to 5 months was just learning what we didn't know and learning about different markets, how to analyze markets, getting connected to the different vendors. And then, month 5 and 6, started putting in offers. Then month 9, we put in some offers. Then you start learning the brutal truth, right? When you're putting in offers, you spend money on appraisals and you spend money on inspections, and then you pull out. And you're like, dang it, I just spent $1,000 on appraisals and inspections, and we're pulling out of the deal. So I think we did that 3 times. I might have spent, I don't know, like $1,500 across just like putting in offers. So I was losing money. I was paying for education. And I'm saying this because if anybody's listening and they're feeling like you're not making progress and you're like taking actions, I think for me, in retrospect, like the actions, the friction to achieve this type of escape velocity, there's just so much friction and barrier to even do deals in the beginning. And then 9 months, we get the deal. Has this ever happened to you guys where construction takes a little bit longer than anticipated?
I think we have a
Right?
unique issue there. Listeners can't relate.
So again, we're like, oh, it's only going to take us 1 month and it's going to be great. And okay, 3 months extra for conversion and all this stuff. So I'm like, oh my goodness. So 3 months, now you got additional holding costs. This is our first deal. Our families told us, don't do it. You're investing out of state. You've never been to the state. You don't know these contractors. You've never met these agents. You never met the lender. You've never even seen the property because we only seen pictures of the property and videos. And everybody was like, how are you going to spend all of your money and do that? And again, this wasn't even all my money. It was my girlfriend's money at the time. We ended up getting married, and so it was really hard from the ego side to have to share all of these blows, because that's what it felt like. It was like these heavy emotional blows. And then we launched. We're 3 months in. We finally launch, and we're using PadSplit, right? We still use PadSplit right now, and we launch, and then within the week of launching and within 2 weeks of launching, getting everything filled, we're like, this is it. This is great. Our bottom floor floods.
Oh,
and I'm just like, dang it. Like, you can't catch a break. And so we got 15 months from us starting to not failing the launch. And I'm telling my wife, I'm like, don't tell your parents. Don't tell until we fix it all. Like, we don't know the damage. And so we had to move people upstairs into other rooms. And it was just like people's stuff got wet. Do we get insurance involved? So like right away, man, I was like, you are an investor. So I think if you are getting punched in the face, figuratively, hopefully not literally, then I think you're earning the stripes. And so
what market did you say? What market this was in?
Atlanta, Georgia. At the time, PadSplit was only in 2 markets. They were in Atlanta, and I think they were in Tampa or Jacksonville.
Okay.
And
and that was your decision for going there?
That was our decision. They were the only one that we knew co-living that we could remotely operate through them.
Gotcha. I just want to say, a lot of people, and I see this a lot, like a lot of people like spin their wheels on what market to invest in. And they like look at all the data and like the employment data and the growth data and the this data and then that data. And then you funnel them all together in your spreadsheet, throw them through ChatGPT. And there's like never really a right answer, right? Oh, like this market's good for this. And this, there's never a clear answer. And so what I find is like people spend a lot of time spinning their wheels and figuring out the market. I would do exactly what Fernando did and find yourself a competitive advantage in whatever market you can. Maybe it's a deal, maybe it's a relationship, maybe it's because PadSplit's there. And those are the markets that you target.
So it has to be something like that. Yeah. And at the time, right now, people might be like, oh, but Atlanta's so saturated. You got so many people there and all these properties. Okay, if that's true, then you find another market that you want to start yourself. And then you're taking on a different risk. You're like, oh, but Nick, nobody's over here. Okay, that's good that you'll be one of few, and you're taking on a different risk at that point.
100%. Can you run us through the numbers on that deal? What you bought it? If you can remember what you bought.
Yeah, it's not fair to talk about, but I'll share. But I don't want to give this false expectation. So I have to preface with, in Atlanta, Georgia, 5 years ago, a 2,000 square foot property was $165,000. We have to start there, because that alone is not possible again in Atlanta right now. And I don't know in what markets, maybe Richmond or maybe these other markets where things are coming up or something, maybe Baltimore, I don't know. But so we start there. Low cost basis, meaning low loan amount. Interest rate 5 years ago on an investment loan was like 3.5%. So again, also like I just got to set the bar there. We converted a 4-bedroom, 2-bath into an 8-bedroom, 2-bath. The nice part about co-living is, as people move out, move in or whatever, like the rents have gone up. So at the time, our rents were $120 a week and now our minimum's $160 a week. It's pretty sweet. So our cost basis, loan amount, everything has stayed low and our rents have gone up. Now PadSplit's fees have changed. So we're probably netting between $2,000 and $3,000 a month after all expenses and after all mortgages are paid. That's on that property. And then we have 3 other properties, and I would say those were probably between $500 and $1,500.
What changed on those properties? Was that because the prices increased and the
that properties, higher loan amounts, higher interest rates. We got 2 of those probably at 8% interest rate DSCR loans, and the loan amounts are in the mid 200s versus these other ones.
There's something else to that too, right? Is like you got into this co-living thing before it was super popular.
Yes.
You in fact did take a risk before pad split was super popular, and you got rewarded for it.
That's right.
Like, was that right? Sure, it can't happen today, but like it's been fledged out, and that happens 100% of the time. You can be a first mover, you can be an early mover, you can take a risk of the unknown, and you get superb returns. And so that's why it's like really important to take calculated risks.
And I think I want to share, I'm curious to get your guys' insight on this too, because at this stage, Miller, you became an entrepreneur basically a year or so ago when you quit.
Mm-hmm. Yeah. Yep. About a year ago.
So I think I'd like for us to talk about risk and how we look at risk. Some people thought it was risky to like do that, for example, right? To invest in pad split remotely, not seeing the property. People thought it's risky to like leave your job and all this stuff. But I think I looked at risk differently. And I'd like to hear you guys' viewpoint on how you looked at risk in making the decision. But for me, people are like, oh, that was risky. But I was like, but I looked at the people's lives that I was around. And I said, do I want their life? If I stay in my current position, I am guaranteed that life. Do I want their life? No. So it's like the risk is just, I felt like if I stayed, I'm guaranteed this life. So for me, it felt more risky to stay because the odds of me having a different life if I stayed is low. So it's a high risk. Should I stay? Maybe my life's going to be different than this person's life in the future, but that's a risk. So I was like, so I felt like I didn't have a choice. Same thing with the investment. Like my wife and I, we were like, okay, do we want to stay working this type of job for the rest of our lives? Not capping on anybody that chose that. But for us, we said we'd rather spend the 65, like all her money and lose knowing that we made the decision. Like we would do that all day.
Yeah, I'm totally with you. I think it's all about your frame. And in fact, I was listening to mine and Craig's first episode the other day because I was reviewing it. And Craig asked me, did I ever feel like quitting at any point? And what I told him was, yeah, I felt like quitting the W-2. And I didn't feel any pressure to quit the entrepreneur thing because that's what I was comparing it to. It's, okay, here's this life as a W-2, looking at the folks around me. Here's the life as an entrepreneur. Yeah, maybe 1 year of dip. Oh, you lose X number of income for a year. But I was like, surely with knowing my own work ethic, and you can evaluate yourself and all that, with an extra year of time not doing a W-2, no way I can't make that back up. And for me, it felt riskier to stay at the job when you step back and compare it to this everyday scenario of the guys that were working around me.
Yeah, man, kudos to you. And Craig, how long have you been an entrepreneur for? How long have you been
I officially quit my job in, I guess, January of 2020. So it's been like 6 years. And my similar thoughts to all what you guys have. But the one thing I'd add to that is like, again, just a little bit more on a spiritual perspective of, I feel like everyone's got like a God-given talent, right? And God has given you like the unlimited potential. And all of us already are not going to live up to what God has had for us in store at birth because we've all sinned, we've all failed, we've all done something wrong, right? Whether it's not taking the risk earlier. And I think there's like an element of faith that comes with it. And so I believe that when you're an entrepreneur, you need a certain level of faith, whether that's a faith in God or faith in yourself, to just take you to that next place and just trust that like you don't know the next step, but you're going to figure it out. You've got a bigger God that's going to protect you and serve you. And so for like me and taking like bigger step and taking risk, it's like I got Jesus with me. Like I'm good, right? Like I know I'm good. That was like that wasn't how I quit, but that's how I'm viewing like risk taking and going bigger now is like having that fuller faith. And then other than what you guys said, like when I made the chance, when it was time to take the risk to quit, it was just a no-brainer. Like I was making triple what I was making in my side hustle than I was at my job.
I think that is different. That there are a lot of people that wait until they exceed their current income before they make the jump. Fernando, I'm curious on your side, but yeah, on my side, we quit well before our cash flow is probably like half or something of my W-2. So it was a little bit of a risk on that side. Again, it was like calculated. But Fernando, how was that whenever you made the jump? Have you actually worked your income yet?
No. I just had a dream, and I was just this kid who thought he was invincible. A 26-year-old that thought that it's worked so far, like why wouldn't it work out again? And then I took a jump. I just tried to start a business on my own, and ended up in 6 months making $300 with $20,000 of credit card debt, crying. That was my life.
I am curious. So you did make that jump, and it didn't quite work. Like I said, I was like very calculated. Okay, I think we can do this in the next 6 months or the next year. I believe in this ability of mine. Here's like a list of pros and cons, like all that. You said that you were very confident, 26-year-old. Is there any like character traits or like projections or whatever you think that you should have done to avoid failure? Or it's, I don't know, I was pretty confident and just sometimes it doesn't work out even though I had the right stuff.
Yeah, no, I think the failure is a prerequisite to success. I don't believe that people achieve any levels of success, significant levels of success, without some category of failures. And then how we frame the failure, you may not call it a failure, or Craig may not call it a failure, but like I'm guaranteeing that we cannot succeed without failures in this whole beings, right? Like even when I launched my first property, the failure of the bottom floor flooding. And if I shared why it flooded, you guys would be like, wow, how did you not know that? That's a failure or whatever. There's all these mini failures that are happening. So for me, and the failures that I had, I needed to go through that because my emotional resilience wasn't built. Like I never was tested. My emotional resilience had never been tested until I was put in that position of failure. And I think that goes for so many people just naturally, like we're going to be tempted or tested. And a big piece of that is emotional resilience.
100%. And I think that's, of course, like it's cliche, but that's what makes you stronger, right? It's like the small problems of first starting out are not even rounding errors like 5 years later, right? Like even a $20,000 expense or credit card bill, like now maybe you can pay that off in a month or two. Whereas before you're like, shoot, we saved 65,000 over 5 years. That's 12,000 a year. So I think as you grow, like sometimes you got to be put against the wall and pressure to get out of that. So then if you got a big student, like for me, I had a huge student loan bill to pay off. Like when I graduated, I paid that off really quick and I paid that off. The payment went away, but the money I was making was still there and it allowed me to elevate. So sometimes your problems are in your way to actually help you later.
I think no doubt.
Yeah, we're getting way more philosophical than I thought we were going to get on this episode, but I love it. I can talk about this stuff all day. Fernando, I want to talk a little bit about, so the business you started, was it the lending business? Was that the first thing or was it?
No, I'm now 7 businesses in and the first 5 were failures. So that was the first one where I thought I'd get overseas international workers for $3 to $5 an hour. And I'd sell them on an hourly basis to business owners for $7 to $15. And I would make an hourly split. Theoretically, it's great. And the business model works. It exists. I just didn't have the skill set to make it work at the time. So that was the first business. And yeah, but there was a lot of benefits to that afterwards. But at the time, that was my first major failure.
We don't need to go into every business just for time constraints, but did you feel like you learned something from every single business going forward? And then like you landed on the lending and that was where you caught some success?
Massively, man. Massively. So that first one, learned how to acquire international labor. I learned how to pay international labor. I knew how to create systems for them to operate in. So there was a lot of things that I learned in the first few businesses that I'm using right now. I learned like Zap, like just these like automation stuff, right? I knew about CRMs and building CRMs out. So there's all these little micro skills that I learned. And then I'm just like, dang, this is so cool that you're like you said earlier, but would you say it was like, they're not even a rounding error to the skills or the money or any of this stuff to where I am now. So yeah, 100%.
Love it. And so what was the impetus and what was the motivation to start the lending company? And was that before or after you bought the program and like all the stuff? And what community did you join?
It was after.
If you like the community you joined, feel free to promote them. If you don't like them, then we can.
They don't exist anymore. So the community doesn't exist anymore. No, I just started the business 2.5 years ago, based off of my biggest failure. If you guys want me to share that one, my biggest.
Yeah. How did the business start? Yeah.
Yeah, I can openly share. Honestly, it doesn't matter. I can openly, transparently share all of my failures because my identity and my belief in myself is not connected to them, which is a different philosophical topic we can touch on another day. But at the time, it was devastating. I was helping a hedge fund raise capital to just make more money, right? And a hedge fund pulls a bunch of money together. They throw it into a business model that's supposed to make more money. There's real estate funds, there's buying businesses funds. And this one, what they did was they helped business owners refinance their high interest debt. So some business owners are on like a 300% per year loan. And then they could help them pay off that loan and get them into a 30% a year loan. And so here we are as a fund, we're able to buy down that debt and then get them lower interest debt, and we charge a percentage of that success. The problem is that it became a Ponzi scheme where a couple of those deals go bad. The CEO doesn't want to share that it went bad. He's still getting a bunch of money coming in. And instead of telling everybody that this isn't going well, he's continuing to receive inbound money and pay distributions on new money. It becomes a Ponzi scheme, even if it didn't start like that. I think that's the biggest learning lesson that I can share with everyone, is that Ponzi schemes don't always start as Ponzi schemes. Something happens. There's a misalignment in the CEO's character. They start to pay distributions on new money coming in, turns into a Ponzi. So we ended up losing about $400,000 of my money, my girlfriend, my wife's money, her parents' money, my parents' money, my brother's money. This is like close family and friends' money. And it was just, and I had a 1-year-old, and this was the 5th business that failed. So now I have no businesses. Now I have no income. And somehow, and I had a 1-year-old that I had to support, and a new marriage. And that was probably the lowest point.
How did like your family, and you're taking their money and you're losing it, and this is your 5th time? No shade, but like people might be like, bro, like maybe go back to that job. So how did that feel? Where'd you go?
Luckily, man, I think what I realized is there's just the love from family. That support system just totally outweighs any possible money support system, because it's just such a beautiful net to fall on, to know that when I shared with my family and everybody, like this happened, they were just like, how can we help? How do we love on you? And so that was like number one, that I still had this baseline level of love. So I never felt like I wasn't getting love, which was really nice. But of course you feel worse, because now you feel like you're disappointing the people that love you.
And so I wish you would have just disowned me.
Yeah.
Stop loving
punishment. Yeah. The punishment isn't good. But going back to emotional resilience, what I loved about that version of me who failed the 5th time, I don't know what the measurement is, but it's like an emotional resilience meter, if I were to call it. How quickly do we bounce back from failure? If you guys ever been through that, where you failed and it takes 2 months to emotionally recover, if you're operating at this line and then you fail and you emotionally sink into this ditch, and you're like, oh, I'm not going to try, I'm not going to do this and that, right? And then it takes a little bit of time. 2 months later, you're maybe operating at the same level you were, and you're like, okay, I'm ready to try again. Let's go give it a shot. Have you guys been through this emotional resilience roller coaster? You guys follow what I'm saying? Maybe not Craig, if he's no, I don't know anything about that.
No, I'm good usually, but
yeah, so that's pretty strong. So I have these moments of weakness, or I still do, but how quickly I bounce back. It compressed from 2 months to 1 month to 2 weeks to the moment where I found out I lost $400,000. I was probably in depression for 3 days, which was great for me. So instead of me measuring myself on the success or on the failure, I measured myself on how quickly I was able to bounce back into a state of perseverance. Mm-hmm. And I was like, okay, this happened. I got a 1-year-old. I can't just live my life in depression forever. I got to bounce back and figure something out. And then boom, on the 3rd day, I snapped my mindset and my state back into motion, and I started to push through. And then soon after that, I took stock into what skills and assets I had, started the lending business.
Did you just start with these skills, like this list, and then figure out what business that lent toward, not to make it punny or whatever, but where did those skills lend towards, and it went towards a lending business?
I literally did that. Okay. I met with a mentor, and he's just write a list of everything all the skills you've developed over the last 5 years or 4 years. And I was like, all right, these are all the skills I've developed and everything. And then from there, we decided there's 2 or 3 avenues I could have pursued. And then I really enjoyed financing and talking financing. Like I could go on podcasts and speak at meetups, and I can talk creatively about all these different loan products, which I'm sure we'll get into. And I just felt my body and my energy changing when I spoke about financing, that we realized we can do something there.
Did you have anybody in your family who was telling you like, hey, we can see that you get excited about certain things, or we can see like your skills lending towards this? Or was it just like your own list that you had there?
Man, yeah, I think it was my own thing. Going back to, I
Okay.
think your question of did my parents or did anybody ever tell me like you should probably go get another job? I don't think anybody understood the position I was in. Like
Mm.
I was probably burning just on credit card payments and loans like $5,000 a month, just on that. And then we need another five or more than that to just live in our own, just live right with our family and stuff. And so we were just in a situation where even if I got another job, like I was just, it was gonna be tough. It was gonna be really hard. I have a funny story. I won't share it right now, but remind me when we're solo. Just how I did try to go get another job, and then short of an answer of it, my wife told me to quit 2 weeks later.
I love that. Fernando, can you just help me marry your two stories together, like with timeline? So you bought the co-living property in 2020 and you're like you're buying
Yes.
those. And then like you're starting all these businesses, I suspect around the same time. Like
Yep.
at what point did you find and start the lending company as like your
Yeah.
company?
So if we bought in 2020, the lending company I didn't start until 2023.
Okay. And so how many
Yeah.
properties did you have when you started the lending company?
I had four.
Okay. And so you were doing co-living and were you
Yeah.
just, bro, did you start the lending company knowing that there was like no co-living specific lenders, or did you just start a lending company and then
Yeah.
realize
Yeah.
the
No, big
niche?
time. Because I saw an opportunity. I saw that there was problems that needed to be solved in the co-living community and nobody was solving them because I had to solve it for myself. So like the four properties that I bought, I had no income and no job. And how did I get to four properties without any income and no money? It's specific lending products that I had to use. So it was because of that. And I was helping other people solve their problems without getting paid. Like people are just coming to me, hey, how'd you do that? Oh, I just did this and go talk to this other person. And I was like, okay, I think I could do this. I think I could help other people solve this problem. And then that's how we started the company.
And I think if I were to write down your skills on a sheet of paper, problem solving, I think would be number one. I've heard you speak 2 or 3 or 4 times at this point. We've hung out.
After singing is number one.
Okay, yeah,
Yes,
singing is number one.
singing is
Yeah,
probably right there.
but that was the first. That was one of the 3 business ideas, and he chose the lending. Yeah, so I would definitely put problem solving at the top for you. I think I've even heard you say being the first kind of specific lender, like for a strategy, and I would consider you that. Like in the short term space, I'm sure in the beginning, yeah, people had no idea what the heck the loans were, and one guy went in there and figured out, hey, there's this regulation. Oh, we could do it this way, and oh, we're actually good to go. We could actually
Yeah.
do short term rental loans this way. And you have that approach to the lending also. I've heard you talk about going through guidelines and figuring out all these different ways to help the investors out. So how important is the problem solving in your business versus, I guess, other lenders who are just already in like an established strategy?
Yeah, no, I love it, man. I think it's a thing that allows me to not be a commodity. If I cannot solve problems better than other brokers or lenders, then I become a commodity. And the only way that I cannot be a commodity is if I continue to pioneer harder problems to solve and then systemize solving those problems so that I'm allowed to scale.
Yeah, I just wanted to say after talking with Fernando, like you present him with a problem and you can see the like mad scientist in his brain, like all the gears turning. And I think that's a really admirable thing. And that's how you break into a space. We just talked about it, right? But you like, whether you know this about yourself or not, but what I'm gathering here, just talking to you here is like, you got into co-living before anybody knew about it. Now you're getting into co-living lending and figuring out all the rules and regulations and the ups and downs and all arounds. And you're like literally paving the way for probably thousands of lenders to come after you, which is like a cool thing to say, even though you probably don't even realize you're doing it. But
Yeah.
you're going to get so much business and so much like clout and all that kind of stuff just being that person to do it. And it's because like you saw a need, you believed in it, and you attacked it. Because there's so many little like demons that'll tell you like, oh, you're not good enough, or oh, that's not really an asset class, or oh, that's just for nothing. But you're ignoring all that and pushing through. So props to you, man. That was
Thanks,
all I wanted
man.
to say.
No, and you have people literally. So in 2023, that's when lending went bad. That's when everybody was going out of lending because rates were at 7-8%.
Mm-hmm.
And so nobody's doing loans. And people were literally like, why would you become a loan officer right now? It's literally the worst time to be a loan officer. And again, how much gratitude I have for all my failures. They didn't know, like the version of me at that fifth failed business, the people didn't know who I was in a good way. Like they didn't know the skills. They didn't know everything that came with me starting that business. And I was just like, let's go. Like I was ready for it.
Okay, I want to pivot here a little bit and I want to talk some tactical
Sure.
stuff. I want to talk like, okay, there's a lot of different people that will be listening to this podcast in a lot of different situations. So I'd like to like kind of paint each situation and tell us what you think is the best loan product. Of course, I know this changes per person,
Yeah.
per credit score, per yada, yada, yada. Let's just talk
How
broadly.
would I tackle it? Let's do it.
Yeah. So, okay, I'm a W-2 employee. I make good money. I've got a good credit score.
Yeah.
I'm in my 20s. I want to do co-living. What's the best loan product for me?
If I'm single and I make good money, I'm looking for a fourplex, and I'm going to go use a primary loan. I'm going to put 3.5% down, and I am going to super house hack that. So I'm going to turn each fourplex into a better co-living unit, live in one room of the one unit, and super house hack the entire complex. That's what I would do.
Boom. Okay. That's it. Any questions you want to add on that? Otherwise, I just want to go to the next one.
Yeah, that's up to you guys. That's how I would do
I
it.
guess if I do want to point one thing out here. So if in a scenario where someone's not house hacking, right? And I'm not going on to a different like bucket here or anything, but like in that sort of scenario, you might be able to buy 4 different properties and it total up to the cost of the fourplex, and maybe you make the same amount of money. But the important thing to point out here is that because you're house hacking, you can just have one loan roughly every 12 months or so. So by getting that fourplex, you're essentially buying 4 properties with one loan, which totally complies with all the owner occupied stuff. So that's just the box that you get put in when you're house hacking. Get as many units, get as big of a house, get as big everything under one roof. Is that kind of the idea there?
Yeah. And then if you converted the living room and the dining room as well for each unit, like you could have 6, 12, 18, like 24 rooms in one fourplex.
For 5% down.
For 5% down.
You'll make your cash on cash return on that is well over 100%.
Yeah.
I can just promise you that because we have deals not as good as that sounds in Colorado, and we get our house hackers well over 100%. Okay, second scenario. I'm a professional. I'm married with kids, got a family, make decent money, good credit score. I'm not moving in anywhere. What's the best loan product?
For that one, then I look at a 10% down second home loan. Can I buy a 10% down second home if it's more than 50 miles away from where I live? Your intentions, right, to make sure we walk on the line here. Your intentions need to be that you're going to occupy the property 14 days out of the year, which is why it's called a second home loan or a vacation home loan. And so if you can live with that intention and you go through the loan and everything, and that's how you want to go through it, just sharing how the loan works. It's up to everybody else on how they actually do it. If somebody says, whatever, without getting into the ethics of all, that's the loan that you can use. That's the loan that people use for buying Airbnbs on waters at 10% down. It's very common. If you're a physician, you're any high income earner, to your point, professional, that's the product. And then just because you're going with such low down payment, right? You want to conserve the capital for your conversion.
You mentioned being like 50 miles away. So what if this person they're already in the town that they think co-living will work well in, then what do you do?
Yeah. If they're already in the town, then the 10% down is going to be tough because they're going to be like, how are you going to use it as a second home loan, or how are you going to do a vacation loan? So then at that point, there's what I tell people, there's 4 things you need on any real estate transaction. There's obviously money, there's time, there's expertise, and there's credit. And so if you as an investor have all 4, if you have money, you have time, you have expertise, or you're building the expertise and you have credit, then you don't need partners. And at that point, just how many assets do you want to own in your personal name? If you're still okay buying assets in your personal name, then there's a 15% down investor loan as well that people can use. And then of course you get better interest rates. You don't have to pay private mortgage insurance once you put 20% down and then 25% down. And then depending on if you want to buy a duplex or a triplex or a fourplex, and you're that same professional, this is where I start to bring in the DSCR loan. Because you cannot buy a 2 to 4 unit property with a conventional loan at 20% down. So when I talk to investors and I say, okay, do you want to buy a duplex? You want to put 20% down, even though you make money, I would suggest the DSCR loan, because DSCR loans, we can go 20% down on 2 to 4 units, which is sick. Most people don't know that. Mm-hmm. They try to go conventional because they can, but then now they're putting an extra 5% down, and 5% on 500 grand is $25,000. It's a good amount of money that they could be using towards the conversion.
Yeah. So I'm curious on your thoughts and like the framework around how much should you put down? So a lot of the time we talk about the minimum. Oh yeah, if I can put down 3.5, great. If I can put down 15, great. If I, whatever it is. How do you actually think about, like you mentioned, all right, there's a 15% down loan, but you could put down 20, 25. When is it good to put more down and less down?
So we've done over 250 loans just since I started the company, right? Two years and change. The only people it's rare that I have people that want to put more down. And some people will say, Fernando, I want to put more down for a lower rate, for a lower payment. And at that, I think it's going to answer your question. I do the math and I say, okay, you want to put an extra 5% down. Let's just say it's a 300. I mean, in Colorado, the average price is like 400, 500, maybe.
We'll say 5.
Okay. So 500. So an extra 5% is 25,000. If everybody did the math and you looked at the difference in rate, maybe it's 0.5%. Sometimes it's only a quarter, but let's just say it's half. If you did the math, you're looking at probably a 10-year return on capital.
Okay.
It'll probably be 10 years before you make back $25,000. So then I just ask the person, hey, can you do more with that $25,000 today? And if they say, yeah, I could, because I'm going to need it for the furniture and for the conversion of the walls and whatever it is, right? Then it's okay. Then you're just essentially financing the 25,000 at a 7% interest rate over the course of 30 years. So that's the logic that places on people.
Is there like a number, so you mentioned like the math here is the break even period, right? Yeah. If you have to put $5,000 down extra and it saves you $1,000 a year, like it's a 5-year payback. Is there like a year number? It depends on the client, but do you see clients be like, if it's less than a 2-year payback, worth it or not? Is there a rule of thumb?
It's rare that it's less than maybe for an interest rate buy down. Somebody says, should I buy down the rate? Which could be, if you just want a better rate, then you could just buy down the rate. Instead of putting $25,000 down, you just put an extra $5,000 down, you buy down the rate, get the same rate. So that's something that I'll do for people. And then in that case, if it makes sense, then yes, buying down the rate, you get your ROC, you get your return on capital back in 5 years, makes sense. Only if they plan to stay in the rate. But if they're going to refinance in 3 to 5 years, then I'm like, you're just buying down, you're putting extra money into the rate, but you want to sell or refinance in 3 to 5 years. I don't know if you should buy down the rate either. So it is dependent on the investor. And then my job, I just ask the questions. I don't want to tell the investor what to do, but I'm like, okay, here's the math. Do you still want to do it? Yes or no? And they're like, and then at the end, they're like, oh, is this too late for me to change? Because they realize how much money is going to be out of their pocket. So then they end up switching from 25 to 20%.
I can almost say I almost never buy down the rate, at least in this environment. I did buy down the rate a couple times when it was like 2 or 3%, because honestly, I knew that like they weren't going to get lower and that we would never refinance. I remember talking to one of my partners. We had on an investment property, we have a 2.25% interest rate. Wow. And we were like, we're never refinancing this, so we should just buy it down because we're going to hold this thing forever. So and that's like a pretty rare scenario, right? Like rates it's rare that they're that low.
I agree with that.
I do want to move on to the next bucket of person, right? Let's say this person is an entrepreneur, not steady income, newly quit their job. So there's no income. They have a little bit of cash, not a ton, and credit's fine. What kind of loan are they getting?
That was me. I was calling myself an entrepreneur right when I quit my job. I had no income. I had no money. I actually did have my 401k, which I ended up liquidating to help me pay my monthly payments on my credit cards. So in that instance, going back to the 4 things, right? You need money, time, expertise, and credit. So I have to take stock as to what do I have? Do I still have the capital to do deals? Do I still have that? Do I have the time? Do I have the expertise? Do I have the credit? And if that's all true, then you can do your DSCR loan by yourself. DSCR loans I don't look at tax returns. We don't look at W-2s. We don't look at pay stubs. You can close in an entity and you can still do deals yourself. You can use hard money loans. You can rehab. You can refinance into DSCR. You can just buy straight up DSCR if you want. These are the same. We have co-living DSCR loans. We have Airbnb, AirDNA, DSCR loans. We have regular long-term rental DSCR loans. So that's the route I would go.
You got to talk to me about co-living DSCR loans. Are they doing that now?
Yes, and we've had to switch co-living lenders 8 times in the last 2 years. So there's a big asterisk there.
Okay. What does that look like? Do they go off of estimated rents, off of pad split rents? What's the...
Yeah. I'll just list out a few things that we've solved for in the past, and then I'll talk about what's currently available. So I'll actually start with what's currently available because that's probably more prevalent, like more relatable right now. We have a lender that goes to 12 beds, or you can even probably do higher in terms of co-living properties, but they will not take co-living income into consideration on the DSCR loan. So they say, hey, you converted your property, you're making money, good for you. I'm going to make sure that if I take over your property, I can break even as a long-term rental. And so they will only look at the long-term market rents as if you're renting this to a single family. And if the DSCR is equal to the monthly payment, so let's say it's a $3,000 monthly payment, if the long-term market rents is $3,000, they'll still do the deal, regardless of how you're doing the co-living and all that stuff.
So it's just a one-to-one?
It's one-to-one. Yeah.
Oh, okay.
So what's the purpose of this being a co-living loan if they're not using the co-living rents and they're using long-term rents? Like, why is this beneficial over a traditional like type of DSCR?
Yeah, good question. One of the hardest things to solve for is not actually the co-living income, it's the co-living property structure, where people are converting a 5-bedroom or a 6-bedroom into a 8, 10, 12. And so the flags that go up are boarding house, illegal boarding house, motel, you've got commercial use, like all these red flags come up with lenders and appraisers. And those are sometimes the hardest things to get through, which we solve for. But that lender specifically solving for the co-living layout, not so much the co-living income.
Okay. I'm still trying to figure it out a little bit. Can you dive into it a little bit? For example, whenever we use traditional DSCR loans, we close on the property when it's a 5-bed and we do our remodel after. So like, why does the lender care about the structure or the layout?
So if you go to refinance, let's say you bought as a 5.3, converted it to...
Yeah, we'll say 10.3.
Okay. When you go to refinance that right now, you probably converted the dining room, split up the master, you probably converted the living room.
Oh, okay. It's for the refi.
Right. So, or you want to sell that property, right? You want to recapitalize, you see a different play that you want to move into. You can take the equity, go buy 2 more co-living properties. You want to sell to somebody as a co-living property.
Gotcha.
You have those 2 scenarios. And Colorado's, I know, is a newer market, but remember, like in Atlanta last year, I was involved in 80 purchase co-living specific transactions of 8 to 12 bedroom homes because Atlanta was such a seasoned market. So that's what we need to solve for. So that's one lender only. There's still more lenders to go through of how I solve problems. And we do have one lender that uses co-living income. Well, that's not true. We have 2, but they only go up to 8 rooms. So there's always,
if you were to do more than 8, are they just including the income of 8 and dumping the 2, or they won't lend if it's over 8?
They won't. At that point, they'll say we can't lend based off the property structure.
Okay.
And then you have to go to the property structure lender. Yeah. So it's actively solving. And by the way, all the lenders that I'm talking to you about, they started lending on or co-living, and then they would stop. And then they would have to revamp their product to create their own risk profile. And then they brought it back.
Are these co-living loans, are they more expensive, like higher closing costs, higher interest rates?
Yeah, maybe one of them probably has higher interest rates, but yeah, that's true. I'd say 0.5% or so. Maybe 0.5% to a percentage, depends on your credit score. And some of them, if you have below a 700, you wouldn't even qualify for a lot of these co-living loans because they're just taking on a different type of risk. So they're cutting the LTVs. Like we can't go 20% down if it's a co-living property right now, which sucks.
What do you have to go with 25?
25. Yeah.
Okay. Can I ask, what are you guys' thoughts on, okay, let's say we got a deal. We're going to use 25% loan to value on your product. And like the seller's willing to finance 25% or 20%. Is there any, can that happen?
Yeah. You would have to sort that out as more of a Morby method. You familiar with that strategy?
No, not really.
So you still need to bring the 25% down. But there are transactional lenders. So we'll go option 1, you have the 25% down plus closing costs. So you buy the property, 25% down plus closing cost off your initial purchase contract. You buy the property. Immediately at the closing table, the seller and the buyer sign a seller finance agreement contract. The same title company opens up a second escrow. That 25% that the buyer just threw in to the purchase, that 25% gets moved. Title doesn't send it to the seller. They send it to the second escrow that just opened based off the seller finance agreement. And then it goes to the second escrow account. The second escrow account, because they executed the contract, once the seller finance is signed, then that funds goes back to the buyer. So then now you've just successfully executed what you wanted.
Wow. Okay. Wow.
So
we may have to rewind. Okay. If you didn't get that,
let's break it down here.
Can I try to reiterate it and then you correct me, just to have a different perspective? We're buying a property, and the idea is we want to come in with eventually no money down within 24 hours. So we get a loan through Fernando, 75% down, and the seller is willing to finance 25% of it. So we come in and we buy the property with 25% down. We borrow that 25% number from mom, dad, random bank, whoever. Anyone will probably lend to you for 24 hours. You bring that cash. At the closing table, you sign the purchase and sale agreement. And then right after that, you sign a seller financing agreement, in which case the seller gets his 75%, the loan amount that Fernando funds. And then the 25% that you bring goes into a separate escrow account. And that escrow account is dictated by the seller financing agreement that you just signed. And that cash goes back to you as the buyer. And now you're paying the seller on the seller financing terms dictated by that document. That's exactly how it works.
It's exactly how it works. There's more nuance in it, but yes, sure. The more nuance is like the money needs to be in your account for at least 2 weeks. Like we need the money in your account probably when you get under contract, because we're going to ask you for bank statements. We don't.
Is it 2 month seasoning? Because that's usually the 2 month seasoning. It's not.
No, if you were to tell me that you're doing that, there's no seasoning period.
Okay, so that's legal then. That's like straight like. There's no seasoning period, and there's no. It's not going to look like a separate loan or something, and you're going to ask for documents on that.
The word legal is because there's gray lines, right? So the gray line is if you're not supposed. I will speak in terms of absolutes to policy and like the legal piece, and then the ethicalness of how people take the gray line is up to them. So what I'll say is, if the money goes into your personal account and gets sent into your business, I legally see that you transferred money into your own business. You follow?
Mm-hmm.
That's all I see. But legally, you're not supposed to borrow money for the down payment. That's ethical.
We'll leave it there. I got it.
Okay, so that's there. The other thing, now legitimately, like at the time of purchase, you cannot have a second lien recorded at the time of purchase. Okay, legal. Now, when something else happens after we close and purchase, ethics. Follow?
Yeah, cool. Got you. And there's no, like the bank doesn't go do like title searches and stuff like that after closing to confirm there's no monkey business going around, or
they can't really do much about it because they validated at the time of purchase it was not a loan.
Okay.
But after you own the property, you could have got a loan for whatever reason.
Can you help? Yeah.
If I'm just going to make up a situation. You got work done on the property the day after and you refuse to pay your contractor. There's going to be they're going to put a mechanics lien.
Yeah.
The bank, like they can't control that. Like they're not going to be.
Fair enough.
So it's like a similar situation.
Yeah. Okay.
But I'm going to put some risk guards because I've been doing this, right? So I think I want to put some disclaimers there.
Do it.
You guys mind? Just because we're out here giving knives to my kid's 4.
Yeah.
I have to choose what kind of knife I give that kid. And right now you don't know who's listening. Are we talking to 4-year-old investors? You know what I mean? They're just getting started and they go and take this knife and it's dangerous. You could get cut. So I want to share how people get cut. The people get cut, like I'm adding myself in here. I went to go buy real estate and I took a HELOC. So it's basically borrowed money for both the down payment and the conversion. So now I am over leveraged by more than 100%. I didn't know how to analyze the deal at that type of leverage just because I was that 4-year-old investor. You get what I'm saying? So even though one of my properties will make $1,000 of cash flow, the HELOC payment to cover the down payment plus the rehab is $1,200 a month. Mm-hmm. So even though the property makes $1,000, I lose $200 a month. And of course, because I'm friends with the investor, like I'm paying that money monthly, even though the property makes money. Isn't that crazy?
Yeah. No, I get that.
So that's the sword. Go ahead.
Everything that we say on this podcast from before now and forever now, know that it's broad advice, and please seek someone with your fiduciary responsibility before you actually go implement it, whether that be a high quality, like investor friendly agent, a lender, something like that. I do want to ask one more question before we move on. This is something that I never understood. Why do sellers care if a seller is like second position?
Why do lenders care?
Why do lenders care if a seller is second position?
A second lien position is able to call foreclosure. And so
before a first position?
Lien, yeah, for a first position. If they call the foreclosure first, then they can get paid out first.
Really? So then
point of the order if it's just whoever calls it first.
Yeah.
I don't know the legalities behind it, but that's some of the concern. I don't know the legality. And so property taxes will always get paid first. So if they're behind on their property taxes, that gets paid first. And then there's some legality on the first and the second. And I don't know all the rules behind it, but in some, I don't want to speak out of turn, but the point is that the second is able to dispute or something like that and might get paid. I don't know the rules, but that's it. Okay. Even if that's really the concern, maybe they don't get paid out 90% of the time. But the fact that now the first lien before they get paid out have to even have this dispute, you know what I mean, is probably alone a operation nightmare.
Yeah. I mean, maybe your example, Fernando, is like why a first lien position lender wouldn't like it. If you took out a second position, you have a lot higher debt now, a lot higher payments. It's now harder for you to pay that first payment that you had because you're paying that extra $1,200.
And they qualified your DSCR loan based off of first lien. Mm-hmm. That's it. So they're qualifying, right? They qualified your debt to income ratio based off the first lien. So would you still qualify? You know what I mean? And so I think that's where some of that gray area comes in.
Yeah, cool. You could be barely qualifying, but if you have a second position, now you're an extra 600 in the hole or something.
Yep. Yeah. And then you end up defaulting. Yeah, I think the default rate could go up. So that this happened pre-2008. They used to give people 2 loans for the down payment and the other side. Like you could literally buy properties with no money down. And it was, at the time, lenders were like, we can all make money. But then people defaulted. And if they default on the second one, then they'll end up, and the property value goes down. I think it was the lenders learned their lesson.
Cool.
Awesome.
Okay, we've probably got time for one more quick question before we head into the final part of the show.
All right, let's rock it.
Cool. Yeah, Fernando, I'm curious. So since you are the co-living lender, like honestly, that is exactly what I would call you. And that's what your Instagram handle should be. I've heard all sorts of different tools that you've pulled out of your tool belt just through us talking over the years. What do you think the top like 2 or 3 co-living specific like hacks are on the lending front? Like what are things that people don't know about? And if they knew this one thing that makes deals now possible?
I think, can I give shout outs on this too? Just so I want
totally.
Credit where credit's due. When Sam Wiegert became a cool friend, where we were doing his deals, we learned a lot, tested a lot of things, and we ended up using this invoice authorization strategy. And actually we use it on Craig's deal too for one of his clients. And so it allows us to finance the conversion in the purchase of the property. And that strategy we've been using so much this past year. And so if you're buying a property for $450,000, the seller, you agreed at $400 with the seller, you can still buy it for $450 with the $50,000 invoice authorization that gets paid to your contractor to finish off the conversion, the furnishing, and all that stuff. So you're financing the co-living conversion in the purchase of the loan.
So to break it down, basically if there's a $50,000 remodel, somehow via some method, if you're able to wrap that into your loan, wrap that construction cost into your purchase, you're kind of like financing your construction costs now, right? So it was 50,000. Now you're bringing 25% of the 50,000 down, and the bank is covering the 75%. So when we think about the math, like when we think about like cash on cash return here, effectively what this does, right? It reduces the amount of cash you have to bring, but it does reduce your cash flow, right? Because your mortgage payment is higher,
goes up,
but it's not higher to the same degree, right? You're bringing way less down and you're paying a little more. Is that how that works?
You got it. That's exactly it. Yeah. And so what we did on Craig's deal is we did the invoice authorization. We went 20% down and he got a $10,000 seller credit. So we stacked the invoice authorization with a seller credit. And I don't know if he ended up getting like 40, he ended up getting, I don't know, close to 40 to 50,000 on that back that he saved in cash out of pocket. But you're right. If he put another 20% down, so let's say he had to put another 10%, $10,000 in. So you're like trading. I'm going to put $10,000 in, but I'm going to get $40,000 back. So it was a good deal.
Great. Love it. The invoice authorization hack is really good. And we couldn't possibly go into all of it, even just in the 5 minutes here. Do some research on it. And if you're really interested, hit up Fernando.
And Fernando's in the co-living cash flow community. So you guys can reach out to him there too. He'll have exact answers. Yeah.
There's one more, if you don't mind, there's one more avatar investor that I wanted to talk to. And it's just one more loan product. And it's the one that I'm doing that I want to do more often this year, because I just think it's such an amazing hack. And it's actually this would fit well for the Craigs of the world, or it's really the entrepreneurs who make good income and don't want to rely on DSCR, and they don't want to use their tax returns, and they don't want to use their pay stubs. But they make good deposits, but they just report that they don't make a lot of money for obvious reasons. So we have something called a bank statement loan. And a bank statement loan will look at the last 12 months of deposits, and we don't look at your expenses. That's wild.
Why don't you? Why don't you look at the expenses?
Because they look at the deposits, and we apply a standard 30% expense ratio, just a flat 30% expense ratio. Will only, of the 100% of deposits that you get, not transfers. So you can't just be like transferring money back to each other and be like, oh, I transferred $1 million. No, it's like, it has to be true deposits, and we'll take 30% off the top. And that 70% becomes the income that we use for the debt to income calculation. And we can close in an entity where the mortgage does not report to your personal credit. So it doesn't impact your true DTI personally, because you're closing in an entity. Why would I recommend? Why is this product so great? Because we can go 15% down with this product. 15% down, invoice authorization, seller credits. You got people like their freaking cash to close is. You guys follow what I'm putting down here? So it's sick, dude. It's like people can do it. Not only that, on a refi, we can go up to 85% rate and term.
Wow. And what's the interest rate on something like that? Is it like super high?
Yeah, high sevens. Okay. Depends on your credit score, but you're going to be high sevens, even low eights if you have a lower credit score. But again, if you are a more experienced investor, or you feel comfortable with this type of stuff, you don't mind the higher interest rate debt because the lower cash to close, blah, 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 like all those benefits, it ultimately works out.
There's almost always like an aha, or like there's got to be like a something somewhere. So I'm just trying to find it there.
Yeah, no, you're absolutely right. That is the gotcha there.
Yeah. So Fernando, what do you think about the lending landscape right now? Because 2008 hit, lending got super duper strict. With products like that, it seems like things are moving like loosey-goosey a little bit. Or we got a quote one time, like pretty recently for DSCR, but they said it was like a no ratio DSCR loan, meaning you don't have to make enough to make the mortgage payment. I'm like, I can't believe lenders are like willing to do this. So what's going on with that? Why does it seem so risky?
Because your LTV is going to be cut. They're we do those no DSCR ones as well, but your LTV is going to be like 70 or 75. So they're not giving you 80 LTV. So then the lender's saying, this is basically an asset loan that we believe the market will not go down more than 20%.
Oh.
So that if we have to sell it, we have to take over your property and sell it, we're not going to lose money. But the lenders lose more money by not moving money. It's a weird thing to think about. If a lender has $100 million in the bank and they cannot make that money make money, how much are they losing every year?
A lot.
At least 3%. You follow? Yeah. So they're losing more money by not giving it away. So they create these loan products so that they can get the money out, so that they're not losing whatever 3% on 100 million is 3 million at least, maybe. Yeah, probably 3 million. That's the point. The lenders need to move the money so that they can continue making money. And they create these types of products that they think they're less risk. We'll find out. We'll see how things go. And then the last thing I'll share on the bank statement loan. The last thing is 80% cash out on the bank statement loan. So that's the last thing. That's the last benefit. And
so if you're to refinance, you're saying?
If you're refinancing.
Refinance 80% cash out. Okay, that's clutch. All right, Fernando. Like I said, we could literally talk to you. We could go another hour, and I actually really enjoy talking to you. You're a good high energy guy. That's fun. But we got to get into the
The
The big what? I can't even
big
understand.
three.
I can't even understand it
We're
I
anymore.
don't even know what
low.
you're saying.
The big three. The big three. I don't
Wait,
have Fernando
Fernando,
singing
wait.
voice.
How would you? Wait, maybe we can all acapella this. What do you think?
Yeah.
The
Big three.
talking the big three up in here. We're ready to start in here. I'm gonna pass it to Miller now.
The first question. Here we go, fellas. That was the big three acapella. Number one question here for Fernando. What's the one tool that you use today, tool or software that you could not live without?
It has to be the automation software in the business. So if you're a beginner, there's something called Zapier. If you're more of an advanced person, there's something called Make Automation. And then if you're super advanced, where you don't mind some development coding stuff, there's one called N8N. This allows me to automate so many parts of my business and my real estate so that I don't have to manually do work.
Do you have one example of how anyone can apply that in their co-living business?
Oh, in their co-living business?
Yeah. Like how could you use Zapier or Make or something like that?
Yeah. So let's see. If you do QuickBooks and something like you want a report sent to your email or to your Slack or to your clients or something like that, then you can use Zapier to pull from QuickBooks. Then you want to read the report. So you push that into ChatGPT. ChatGPT reads your statements and your QuickBooks and gives you an analysis. Then it sends you that in an email to whoever your partners are. So if you're raising capital or whatever, and you've got monthly reports you want to send out with a summary, that's what you could do. And you would use Zapier, connect it into ChatGPT, connect it into email.
Perfect example.
Cool. What is a horror story, whether it's a deal, lending situation, or maybe it's something in your own property, like a tenant horror story that happened, and what did it teach you?
Real estate's not passive. It's probably the learning lesson I'll share right now. As much as I wanted to believe it was, being in it for 5 years, the real estate, so the horror stories are that one of my properties were like negative $20,000 for the year. And you're like, why is that? And it's because we had to fire 2 property managers. Then we had to evict 5 people out of one of our co-living properties. And then they messed up their rooms. So we had to rehab those rooms and get them back to market.
Wow.
And just for one of the rooms was $8,000. And so it's, dang, this is a lot. And at the same time, this property the year before generated over $20,000. So the nice part about that is you're not losing money for 20 years. You lost money for a year, and then we got to make it back for the next year. But the learning lesson there is, for me, it's like real estate's not passive, because you're going to need to replace the roof. You're going to need to replace washers and stoves, and you're going to have to evict people. And it's hard for me to believe 100% that real estate's passive as I'm scaling my portfolio, because that's 34 doors, even though I'm a business owner.
If you're wanting passive real estate, the way to do it passively is invest in other people's deals, be an LP.
There you go.
Invest in REITs, real estate investment trusts.
There you go.
And this is still not quite passive, but like it's scratching this tip of passive, is buy traditional long-term rentals and get a really great property manager on it. Because I will say, I've got some properties in North Carolina like that, and I don't even think about them. And they're like, I do have to answer emails maybe a couple times a year, but that's about it.
Oh, that's sweet.
So,
yeah. So I think, you got it. Private money partnerships, I think, can be passive.
Yeah.
Because I'm the one that has to, okay, so I will caveat that with, I'm the one doing the work for my partnerships.
Yeah.
So it's passive for them as the private money partner, but it's work for me. I think the same for you, Miller.
Yep. Same exact structure.
Yeah. Yep. So it's passive for your partners, not passive for you.
Yeah. No. Yeah. If my job was passive, that's why we make the money, right? With any sort of investment, the more work you put into it, rule of thumb, you should make more money. That's why short-term rentals make more money. Takes a lot of work. Co-living takes a lot of work. Long-term rental, like Craig said, you can get it passive because it takes a lot less work.
Yep.
Yeah. All right. So taking you to the third and final question here, Fernando, not including our group or this podcast here, what's your best source of co-living content today? Like, where are you learning the most and the best?
Man, I want to say, where am I learning the most of co-living content? What are we speaking about? What would you
Yeah, you
think
can. Yeah,
about that?
a book, a podcast, a community. Like where's the best place to go to get co-living stuff other than here?
To learn about co-living stuff, man.
Yeah.
There's the Pad Split host group community that people share a lot in.
Okay.
There's just Facebook groups. There's more Facebook groups coming up, right?
Yeah.
More if somebody just types co-living Facebook groups or co-living real estate in Facebook, there's more communities coming up, especially in the actual cities. You might have co-living communities just in specific cities in Florida and Arizona, Colorado. So I would say for people to go there. And then honestly, sometimes it's like for me right now, because I have access to people like you guys or Sam's or just different property managers in the co-living world, I can reach out and get info from them too.
Awesome.
Awesome.
Yeah, great.
Great. That's fantastic. Fernando, last question and most important. Where can listeners find you if they want to learn more about you, learn more about co-living, lending, all that kind of stuff? Where's the best place?
Follow me on Instagram. Handles it's Fernando Corona. ITS Fernando Corona. I think I'm making a big push to build the brand there and share more educational co-living content. And then from there you can get pushed into other channels to learn more.
Awesome. Fernando, it's been an absolute pleasure. You, as expected, dropped lots of gold all throughout, whether it's we talked philosophical stuff, we talked going deep stuff, we talked lending tactics, we talked any position you're in, what loan is best for you, and then also some hacks as well. Like, phenomenal, man. Thank you so much for coming on.
Yeah.
We'll talk soon for sure. Actually, I'm talking to you on Friday. I'm talking to you tomorrow. So I'll talk to you tomorrow, Fernando.
Appreciate you guys. Thanks, Miller.
See you, man.
Thanks, Greg.
See ya.
And that was Fernando Corona. Miller, what'd you think of Fernando?
Yeah, always incredible wealth of knowledge there. I honestly don't know a co-living lender that knows more about specifically the co-living lending, right? Co-living is newer strategy. Lenders look at it strangely. And Fernando's kind of the one moving forward into the darkness with the lantern, figuring it out and letting us all know how to actually go through it. So definitely recommend reaching out to him for all your lending concerns in co-living. He's incredible.
Yeah, 100%. Fernando is such a good guy. And we bring a lot of different people on the show that have expertises on different realms. And that's why this show altogether is all things co-living, right? And so today was a little bit more acquisition heavy, which I'm a fan of. But obviously we'll have some other shows and probably multiple, maybe even the majority of them will be more on the operation side because that's what a lot of people are interested in. But if you can't acquire good, you can't operate good. It's all synonymous. And that's why the show is coming together. And the way that this show continues, and we can continue to bring on more and more guests, is if you leave us an amazing rating and review. So go to Spotify, go to iTunes, share this with one other person. And like, your spouse counts, okay? Share this with one other person and get them to start listening and have them share it with one other person. And that's how this thing spreads like wildfire. Co-living really takes off, and we can really make a big dent in helping reduce the cost of living for lots of people and getting investors larger returns.
Yeah. And also, if you guys could comment and tell Craig to stop saying iTunes. I don't think iTunes is still a thing anymore. Craig's just been podcasting for so long. I think it's probably
Really?
Apple Music is what people would say now.
Do people not go on iTunes anymore?
I don't think iTunes exists I'm pretty sure it's rebranded 5 years ago. So Craig's just a veteran. So we'll give it to him.
Man, I'm a boomer. Okay. I didn't even know that. Clearly, I don't listen on iTunes or Apple Music or whatever you call it. I'm a Spotify guy. So
there we go.
Cool. All right. We'll see you guys all next week. Thank you so much for coming on. We'll talk soon.